So in the studio, I've got Kevin Lings from Stanlib. We've got Andrew Ditburner from Cannon Asset Managers, and joining us from our Cape Town studio is Kolofelo Maele. She's the chemicals analyst at Frost and Sullivan. Kolofelo, let's start with your thoughts on these numbers. Half-year results out from AECI. Headline earnings per share up 127%. The stock today closing at 69 Rand, down 1%. It looks as though the market was expecting very buoyant numbers.
Yeah, I definitely think so. I think the market was expecting quite a bit of a turnaround because we have seen the manufacturing sector and the mining start to see increased activity following the sort of depressed performance last year. So AECI has seen lots of volume growth in both the mining services and specialty chemicals divisions. A little bit less revenue growth there was a decline in revenue growth from the specialty chemical side, while mining saw a lot more growth. So very good performance from all sectors.
And actually the stock closing at 68 Rand, down 1%. Andrew, let's get your thoughts.
Obviously, their earnings improved, obviously coming off a low base. That's in line with the manufacturing and mining sectors. Their dividend, they had a big increase in their dividend, which was very nice to see. This isn't a company that we hold. The interest rates played a part as well. They went on a big capex spend a few years ago. So obviously they've got a half finance costs in there as well. So the low interest rate helped it. We prefer in this sector Omnia.
You prefer Omnia in this sector. You're obviously holders of Omnia.
We do hold Omnia. Again, you've got to value these on forward PEs and Graham and Dodd PE ratios. Looking at their past earnings doesn't really give you much idea of what the company is going to do going forward. But having said that, AECI's numbers today did look quite good, and this is moving into cheaper territory, and it is going to be a stock that we're definitely going to start looking at a lot more closely.
Kevin, going back to Hudaco's results out recently, the company has 2/3 of its products into the mining and manufacturing industry, and from the CEO Stephen Connolly at Hudaco, a very somber outlook on the mining and manufacturing industry. We're not seeing same picture from AECI today.
Well, I'm saying that there is a similarity between all of these companies in the sense that we've seen spectacular numbers in manufacturing and in mining activity over the last year, without being semantic about which quarters were better, etc., but generally. And that's the recovery. And that recovery has been partly driven by a global recovery, a pickup in world trade, and a normalization of inventories. I'm going to keep stressing this inventory thing is a huge thing. Now we enter an environment where all of that has been kind of normalized, and in order to keep industry growing, production growing, you need somebody to consume the stuff at the end, what we call final demand, and that's not quite there. So you've seen spectacular improvements relative to a low base in a number of companies, but I'm questioning whether you're going to see that continue on at quite the same pace, and I'm skeptical. In order for AECI to do well over the next year, the next 2 years, what really needs to happen? Industry has to flourish, so the offtake has to flourish into general industry, into mining activity. Are we expecting to see mining expansion? Are we expecting to see industry building more capacity, etc.? Capacity utilization is well below average still. I'm not expecting to see a huge pickup. So you're getting a fall off in the recession, a bounce now, and you're going to go through a soft period. Therefore, when you look at the valuations, yes, they may appear cheap, but they appear cheap relative to quite high expectations on earnings. And the theme we've been having on this desk is that earnings still are too high. And I think that as you look into the next period, yes, you get 100% off a low base, but as you look into the next period, maybe those earnings are too high, so the valuation's not quite as spectacular.
Kolofelo, let's come back to you in Cape Town and looking at the theme around additional capacity. We've seen capital expenditure from this company, AECI, and we aren't seeing volumes at those pre-2008 levels. Is this going to be a problem for some time for the company, or do you think that volumes will right themselves?
I think that we're definitely not going to see volumes returning to pre-2008 levels in the short term. I think it's not realistic to expect such high growth over, volumes returning to those levels in such a short space of time. What I do think, though, is that their capital expenditure programs show a lot of foresight in terms of what the market will be doing. And I think the fact that AECI is also looking at not just their South African market, but the rest of Africa, Asia Pacific, I think that's also a good focus for them in terms of trying to grow their volumes as well. So yes, the volumes will not necessarily return to those levels in the short term, but I think if you're looking in the long term, you will start to see sustained growth. But I do agree that it's not going to be at the same rate that you've been seeing over the last 6 months.
And then, Kolofelo, having gone through your research this afternoon, you also allude to the research and development that AECI has undertaken in new technology that you see as a big positive for the group going forward. Can you elaborate?
Yes, definitely. I think that investment into research and development has definitely been one of the key things that has kept AECI's mining explosives division at the forefront of its game. They do compete with, say, your BME, which is an Omnia company. But I think the fact that they continually invest in improving these technologies, including the completion of their plant, their more automated plant for shock tube systems, is a big competitive advantage. You also see a lot more work between the different divisions in AECI, with Lake Technologies working with AEL to develop a new homogenizer for their bulk emulsions. So those kinds of investments into technology are really going to be a key competitive advantage into the mining sector.
Kolofelo, thank you very much for that update. That was Kolofelo Maele, chemicals analyst at Frost & Sullivan, joining us from our Cape Town studio. Coming back to the local market and what you anticipate, coming back to your theme on earnings and the fact that this is a key concern area for you, Kevin.
Yeah, look, I think the earnings that we've had over the last while, and we've seen it in the US, I mean, those earnings have been great, and generally the market has done well this month, and if you say why, it's because the earnings globally have tended to come through. We know that, but that's not really the issue. The issue is how expensive is this market if we look forward over the next 12 months, and in my head, what we've got is a very optimistic earnings outlook. In many companies, we've got earnings expectations back to all-time highs. Whereas if you listen to the discussion on AECI, we're saying, oh, maybe volumes won't go back to that previous level for some time. And that's the discord that you've got at the moment. Your baseline activity is not going back to record levels, but you think earnings will go back. Now, earnings have recovered so far simply because you've taken costs out of the business, you've fired people, you've cut back on capital expenditure. So you've got a spectacular improvement in earnings. From here, it's much harder to keep the earnings growing. You need to sell more of your stuff. And not all the companies are going to be able to do that. And I'm just saying, there has to be an earnings realization or earnings normalization to what's really going on in the real world. That hasn't happened yet.
And how about and this is a theme that we've been rolling out on both Closing Bell and Business Tonight, the fact that investor relations departments, CEOs of companies are that much more cognizant of managing investors' expectations around earnings. So that's why we're seeing, and you put out the report recently, Kevin, that of the S&P 500 companies, 100 had reported and 76% had beaten earnings expectations, 65% only to beat on the top line growth. But do you think that that's a big theme that's happening at the moment?
Yeah, we saw, I think it was Coke, ConocoPhillips. We saw quite a few companies in the States report today, and all those earnings do look good. Having said that, though,
do they look good, or are they just beating expectations?
They're beating expectations in general. Having said that, we're a value manager. We're not looking for growth in the short term. We're not worried about what's going to happen 6 months, 1 year out. We take a long-term view, 3 to 5 years. Look for deep value companies that we think have good growth potential going forward. And we still do find those opportunities in the market today.
Gentlemen, time is up. We'll give you 20 seconds.
I'm saying let's focus on when we see the earnings. Let's ask ourselves a question, is this quality, good quality earnings, or is it just earnings? And there's a big difference. Are we growing the top line, or are we just growing earnings because we're taking costs out of the business? And I think in the next reporting season, and as we get into the next sort of thought about earnings, we're going to ask that question, what is the quality of the earnings coming through?